Hi, Sean Haynes with Agri-CFO in the Ag Center, giving you a weekly update in California dairy markets. Cheese prices continue to fall, pulling dairy market prices down for Class 3 and Class 4 on the blend. Actually, just the Class 3 really pulling it hard, down below 17 bucks for the current month, looking to stay down low 17s the next 60, 90 days after that. And then popping up toward the late summer into the high 18s, but really coming off about 75 cents from where they've been the past couple months. Beef on the cull side and beef on the crossbred calf side still remaining high, 400 to 415, 420 for those crossbred calves, bull calves around 150, and then cull cattle going about 90 cents to $1.10. Feed cost wise, coming off, almond hull's down quite a bit from historical levels, the 175 to 185 range. Hay's been kind of holding steady, not really moving up, but a lot of pressure to kind of come off a little bit. And then corn silage just coming off quite a bit in the field on these few contracts I have been seeing for grown silage in the field at 50 bucks a ton versus say, in the 65 to $75 a ton in the past year or so. So there'll be some relief as we kind of reset to these new contracts and reset to new feed costs, but that really won't be seen until September. Butter doesn't look like it's going to fall apart though, so that's the real worry. And if butter to fall apart too, you're looking at $14 milk. But U.S. butter versus international butter prices still pretty comparable, so that's holding that market up well there. It's just really this cheese price has been just killing guys. So that's the quick and dirty we've got on dairy markets. Thanks. Bye. Beef prices still remaining high, up and down across the board. A penny here, penny there, kind of neutral. 4.5 weight crossbred cattle are still in the 235 to 260 range, depending on the month you're looking at. Native cattle as high as 288. As low as 235 for the same weighted cattle. Grass rates have been kind of pushing up as guys are filling up cattle up in the hills, and then pears are off a couple $300 from where they were at a high of a couple months ago. There was as high as 32 to 100 a pair, down to $1,500 a pair, an average of 2,300 bucks. Average seems to have kind of pushed down to $1,900, $2,000 per pair as guys have kind of filled up spots in the foothills. Maybe lower cattle quality kind of hitting the market too. Long range for the beef markets look good. Grain costs to feed the cattle are off. Boxed beef values are up 3 or 4 cents this week to 305 and 285 for choice and select. So it looks like we're going to stay in profitable range across the board on most animals if you got them. Black spot have been pushing up grass prices up in the foothills. Plenty of grass up there, but lots of demand for it. So guys have been, asking for premiums on the rates. Good moisture back east, which should take some stress off. We'll see also this be some substitute pressure from poultry and pork as both of those supplies are looking to increase about between 2 and 6% this year with prices falling off. So we'll see what that does to the beef market. And the long and the short, looks like profitable times for beef producers and beef packers for the near future. Thanks. Rates continue to push up. After the FOMC pushed rates to 5 to 5.25 range for the near future, we're looking at home loan rates really getting close to that 8 range, 7.5, 7.6 on the 30-year money. Jumbo rates probably about a quarter point to a third of a point off of that. They've really kind of closed the gap there as well. For the ag real estate rates, rates are still high. Same thing in a 6.5 to 8% range, depending on the size of the borrower and quality. Equipment rates stay steady. 6 3/4 to 8.25% between 5 and 7-year money. Operating loans have kind of gone up on the short-term side. They're in the 8.5 to 7.5 range. And I think what you're going to see is a general tightening of credit conditions now too as well. You've got $5.4 trillion worth of money sitting in money markets now that have been pulled out of general deposits, which is 25% of all U.S. deposits now are sitting in money market funds. You've also got increasing delinquency rates, an increase in bankruptcy rates as far as businesses go. And so you've got this tightening on the supply of money, which causes the cost of that money to go up. And if I'm a bank, the way I make that go away is I usually have less loans on the smaller side, right? So I'm going to get rid of these smaller loans. Large loans are always going to be home for them. I think consumer debt's going to get squeezed as banks kind of try to conserve capital to make money on and lend it out to higher margin businesses, or at least ones that don't have the overhead cost to it. That's the quick and dirty interest rates in the markets. Thanks. Almonds are still coming off a little bit from the subjective estimate that came out at 2.5 billion pounds. Still in the, on the nonpareil side in the $2 range to just below to above it, depending on what the blend is. Nonpareils and independents seem to be leading the way for quality and size. As long as those are good, you're going to get a decent price. If we get into a recession, you might see some help on the nut side as far as pricing goes, because it makes the U.S. dollar weak, makes the buying power of outside parties, which buy 85% of our product, right, outside the U.S., makes their buying power a lot stronger, so may move some more additional product and push some price up because of that. So we'll have to see. Hull prices, because of that size of crop, I think, and also this hand-to-mouth thing that's going with the dairy industry because they're just having a hard time cash flowing right now. It's been pushing those hull prices down into the 185 to 175 kind of range. It's been all over the place right there. But on the walnut side, not a whole lot of movement, still depressed. If you got jumbo large chandlers, you're still, from at least from the sales reports I'm seeing, they're still offering those at 85 cents per pound, which with guys can make a little bit of money to break even. Pistachios, don't really have a read on the pricing for those right now. I mean, as always, demand remains high. We're a large producer in the world. We will have a special report coming out in June from one of our partners, kind of giving a subjective estimate of where the crop's at, kind of where current pricing is, and maybe some non-bearing acreage. And that's about the quick and dirty update I've got on nuts this week. Thanks. Bye. Across the state, everything's in full bore. Most of the winter forage crops have been pulled off, and we've had some good yields. No surprise in the pricing there, looking about $55 to $65 per ton on average for that wheat forage or oat forage that came off this year. Wheat and oat hay has been kind of down 150 to 180 range. Alfalfa is still trading about the same range, 385 to 420, depending on quality. On the cherry side, cherry production is full swing. Crop looks like it's about 60% larger than last year. Box prices for those cherries should be much higher. At the beginning of the season, I think what you're going to see is a lot of fresh fruit were kind of delayed and usually would compete with cherries for space. Looks like they're delayed just like cherries were, but cherries are kind of hitting that market first, going to take a little bit of market share, a little bit of price benefit, and then fall back off again, maybe in the $25 to $30 range. Strawberry side, strawberries are in full swing. We're about 2 weeks out from peak production as far as pulling them off. Prices on the organic side have fallen to about $12. They were running about $16 for a while per box. And then conventionals around $8 to $10. They were running about $2 more per box per carton as well. I think the other thing that's pretty interesting to see is that we're off about 30 to 40% from last year as far as the available strawberries coming out of California. That really speaks to a lot of the damage the ground took during the floods and the fact that guys just couldn't get in or crops just got washed away. And that's quick and dirty on the crops, California. Thanks. One of the topics I talk with my clients about, especially when they're diversified many crops that they're farming, is the difference between variable and fixed expenses or overhead. Fixed overhead are going to be things like your land rent, your mortgage costs, insurance, your truck payment, things that aren't going to move up or down with the amount of acreage that you're farming or the amount of crop that you put on. Your variable expenses are going to be things that do. So if I farm an extra acre of tomatoes, for example, or an extra acre of corn, I'm going to have some expenses that move up with that. And the reason it's important to understand those is if I've got a crop, I've got to understand how to peel off that overhead and say, here, that's my nut. I got to make enough profit from my crops above my variable expenses to cover my fixed every year. So if I've got a crop that's got $1,100 in variable expenses against it and it makes me $1,000 of revenue, I have a $100 per acre loss. That $100 acre per loss adds to my overhead. It doesn't subtract from it, right? But if I have the opposite, if I have a $1,200 revenue on that crop and have $1,100 expenses, it provides $100 per acre to cover my overhead expense, right? So if a crop is profitable or not, right, it's going to expand or contract my overhead that I got to carry. Folks that understand that mix and get the right crop mix to do that are much farther ahead on a year-to-year basis than the folks that don't. So hopefully that kind of helps with that concept. And if you want to hear more, have additional questions, just reply to this post. Thanks.